This is Money Mind. On this channel, we'll talk about money saving tips, investing, so we can all achieve that financial independence. And today's topic will be on Select the Sector SPDR ETF, and I'll let you know 4 things about Select the Sector SPDR ETF: what it is, composition of it in S&P 500, benefit of using this type of ETF, and investment strategy if you wanna invest in these ETFs. So what is selected sector SPDRs? So S&P 500, which are the biggest, largest US companies, right? The 500 of them, or 508. As you know, there's Apple, Microsoft, there's McDonald's, there's Procter and Gamble. So in those 500 companies, there's different sectors of the economy, and that's what compose the economy. We know economy, we have 11 sectors. There's real estate, there's utility, there's different companies. So in investing, you can just go buy one S&P 500 ETF that will cover everything, right? But also you can choose and pick and choose what sector you want to invest in, right? That's why this SPDR ETF come in hand. And as we can see, we have 11 of them here, right? If we start from here, we have energy, which is about composition of it in S&P 500 is only 4.4. We have utility 3.6. We have technology, which is pretty much dominant. It's a 22% of S&P. We have material, we have consumer staples, consumer discretionary, industrial 9%. We have communication services, AT&T, that's Verizon, that's your big telecommunication company. We have healthcare. Johnson & Johnson, for example, will be one of the biggest healthcare, will be in this sector. Financial, of course, we have, those are the banks, right? The Chase, the JP Morgan, the Wells Fargo, Bank of America. 12.71%. There's real estate. So these are all your real estate, like residential, commercial, and malls and all that stuff. That will be real estate. That's composition of it, as you can see, is 3.27%. So as you can see here, we can see technology and financial, they're the most dominant, and healthcare actually. Healthcare is actually 13%, and technology is 22%. So technology is way overweight on this, on S&P 500. Because as you know, these are 11 sectors that compose S&P 500. So now, what's the benefit of these ETF? Why they SPDR decided to make kind of make this one individual ETF? So there's a benefit to using this ETF rather than just buying one ETF, right? One of the benefit we'll see right here, that will be diversification, right? For example, you say, well, S&P 500 has too much of technology in one, right? They don't have utility, so you can just buy more utility. So you can just buy one and compose your own S&P 500 using this ETF. Low expenses, if you do combine all of them, your MER will be 0.13. It's a little bit higher end because you can just buy VOO, which will be a little bit cheaper. It's only 0.03, right? So it's way cheaper. But you get one, you give up the other one. So if you want to use this one, then you have to be willing to pay a little bit more. There is asset allocation, right? There is a tax efficiency, there's a flexibility, there's a transparent, dividends, and tradable. Dividend, I'll talk a little bit about dividend. So let's say, for example, S&P 500 pays only about 2%, right? And you say, well, you know what? I want to make more money because some of these sectors on these spiders, right? They pay more dividend than the other sectors. For example, utility and real estate tend to pay more dividend. So if your goal is dividend, for example, you can just invest in this one and this one, then your dividend I think will be up to 4%. So you can get more dividend if you customize this, because as you know, technology takes more of this, which most technology company don't pay dividend, right? You know, you're looking for growth rather than dividends or income. So you can just customize and get dividend on these things. You can just buy utility and real estate and healthcare and some industrial and financial. These are the sectors of economy that tend to pay more dividend, right? So you can just buy those ones customized to get more dividend rather than buying S&P 500, right? And flexibility, because you can customize them. You can say, well, you know, S&P 500 has more composition in finance, for example, and I want to have more in technology. I mean, I want to have more of material, for example. Then you can just customize whatever you want. And also tax efficiency. Let's say, for example, you have another mutual fund, or you have other individual stocks, or you have taxable account, for example, right? So tax efficient income, especially in taxable account. So if you have 500 S&P 500, and you say, well, you know what, I don't want to pay much tax, right? So you can just buy, for example, technology, which doesn't pay as much dividend. So if you put on taxable account, where you don't receive much dividend, you know, you just invest for growth, then you don't have to pay much tax because you don't get dividend, right? But if you invest in, for example, real estate, which are going to pay you interest, right? Most of those dividend will be taxed at your marginal rate. So you can customize to make sure you don't have any interest paying security in your S&P 500. So that's benefit of it. And last but not the least is strategy. How can you use those ETF? How can you use this sector spider ETF to invest? There's a different ways to do it, and one of the way is to equal weight. So you can actually equal weight them, because S&P 500, as you understand it, as I mentioned earlier, you can see back, I showed you. You can see how they did. For example, they did. You can see in this chart. For example, consumer discretionary rates 10%. Technology is 22, right? Real estate is only 3. Healthcare is 13, right? So one investing strategy, you can just equal weight them. You can just put all of them equal weight, you know, 10% or 9.09% each one of them, and that will be equal weight. That strategy, it can be good for down economy. For example, when the technology, your portfolio will perform closely to S&P 500, but will be a little bit less volatile, because you don't have, let's say, for example, this time technology is very volatile, but because your portfolio is more of eco balanced, it will be less volatile, right? You might have a little bit less of return than the actual S&P 500, but will be less volatile, right? That's one strategy to invest in those, right? Another strategy is asset allocation. What you can do is, let's say, for example, you say, you know what, at this time of economy, I think utility, I think oil and gas, which is energy, they are more, it's the best time. I think it is time to invest in this one. So you can actually just invest in those two, which is invest in sector, not an individual security. So instead of buying, for example, ExxonMobil, buying those individual companies, you can just say, well, I want to invest in utility and oil and gas. So you can just buy those two ETF to invest in economy, or in to build your portfolio, right? So that's it. So there's the four things. There's a composition in S&P 500, which I mentioned. There's a benefit of it. There's a S&P, and then there's what it is, sector spiders. So I think that's it for today. If you like this video, please leave a comment, like this video, and please subscribe.